Hello, everyone, and welcome back to the Direct Insurance Podcast, otherwise known as DIP, a podcast for independent insurance agents brought to you by Insurance Advisors Direct, a full-service FMO. I'm your host. My name is Kelsey. I'm the digital marketing assistant here at IAD, as well as social media strategist. And today I have a very special guest. Welcome back, Robert Intelisano. Tell us a little bit about yourself, Robert.
Yes, Kelsey, thanks for having me. I was recruited actually into the insurance industry while I was actually in college at Lehigh in Bethlehem, Pennsylvania. Prudential came on campus, and that's how it started, and took all my tests, my licensing, and knocked it all out. So I was able to get off to a nice jump start without having to study for tests and just focusing on work. So I started with Pru for 10 years. Then I opened in 1999, to quote the great Prince, we've been partying since 1999. And that's when I opened up my own company, because I felt like there's a difference between what's called a captive agent and an independent broker. A captive agent is an employee of a company, and they represent a company. And I felt like Prudential can't be the best in every product, so I want what's right for my clients. So I opened up my own company called Intelisano Associates Inc. and in 1999, and it's been great ever since.
Yeah, and your clients know you as the insurance doctor, correct?
They do. Not all of them call me that, but I got the name because I'm a little old school, like a new school, old school hybrid, where when I have an initial meeting, I'm not getting all technical. I'm going in with a pad and a pen and asking some questions. We're having a more like a sit down over coffee, and I'm going to get to know them. And then there'll be a second meeting where we'll make recommendations.
Yeah, so it's kind of almost like you're diagnosing their financial goals in a sense.
I'm diagnosing, and I need to know if there's any, they're allergic to any medications as well.
Oh, yeah, that too. There we go. But yeah, so today we are going to be talking about annuities. So we're going to be talking about some features and benefits of annuities, and as well as some of the pitfalls of annuities as well. So we're going to be talking about annuities, features tell and benefits sell. So let's go ahead and dip into some insurance. So Rob, give me an elementary definition of what is an annuity.
Yes, an annuity basically is a contract between you and the insurance company, and where you're going to make either a lump sum or a series of periodic payments, or a combination of both, and in return for a guaranteed interest rate and or guaranteed income down the road from the insurance company.
Awesome. So there are two different types of annuities that we're going to be talking about today, and one is fixed and the other is variable. Can you explain to us the difference between the two?
Yeah, this is a really big difference. So a fixed annuity, okay, first of all, there's no market risk, and that's why it's under the insurance license, because it's insured and protected, issued by an insurance company, and there are no fees. The interest rates are guaranteed, so you have pretty much everything is guaranteed. A variable annuity is also a tax-deferred product like fixed. However, it's tied into the market. I like sometimes to explain it where it's a tax-deferred mutual fund. So you're in the market, and it can go up or down, but it's going to be tax deferred.
Awesome. Okay. So let's go ahead and talk about some typical annuity contract characteristics. So let's go ahead and go through some typical charges and adjustments of annuities. So explain to us, what is the percentage of premium charge?
Okay. So with fixed annuities, it works a little different. It's determined by the state. So it's important to understand how different industries are regulated. So for example, banking, you have what's called FDIC. There was just a huge banking crisis, which we'll probably touch on at some point in this interview. So FDIC, Federal Deposit Insurance Corporation. So banks are federally regulated. You're going to have the same rules where I am in New York, where you are in Michigan. You're going to get $250,000 of state protection if something happens, if the bank goes under. So in the insurance industry, also like investments is FINRA or the SEC. So stock markets regulated. Every New York state rules will be the same as Michigan rules, but state insurance is state regulated. So each state has different rules and different products, and you need a different license, and different states have what's called a state premium tax. So there are some states that will actually take a percentage of your premium when you buy an annuity, and other states won't. So it's very important to see in advance for independent brokers to know where the state premium taxes are, which states have them, and how much they are.
I think that's really important to note as well, because that might even impact the different states that a broker might want to become licensed in. Because if there are certain fees and charges that'll happen to an annuity account in a certain state, where to a point where the client is essentially not really going to be gaining anything up front, it might not even be worth it for them to become licensed in that state unless they live there and they have clients that they would be serving, particularly in that state. So that's important to know. So
before you get to the next question, I want to touch on that. So I'm in New York. So obviously I'm going to get licensed in New York. Usually you want to be licensed in bordering states. Mm-hmm. And it also states where there's a phrase called snowbirds. So in New York, a lot of people will have a second home, and it's going to be usually a sunny state like Arizona, California, Florida, Texas. So these are states where if you may have a lot of people that have common homes in both states, New York and other state. Now, Michigan, there's got to be certain states where if you live in Michigan, where a lot of people will have maybe a second home or a business in either a boarding state or maybe a warmer weather state. So it would be important to be licensed in those type of states and also to know what the rules are in those states. Like I just give an example, like if for West Coast people, my best friend is in California. California, they have the state premium tax on annuities. You may say, okay, well, we can go to Nevada. Now, Nevada, it's for qualified money, they have no premium tax, but for non-qualified money, they have a 3.5% premium tax. It's the highest in the country. So you're doing your, if it's a non-qualified situation and your client has a home in California, Nevada, and you write a non-qualified annuity in Nevada, you're not doing the right thing for that client.
Yeah, that's something very important to note as well. Okay, so let's go ahead and talk about contract fees. So explain to us what contract fees are and maybe how they differ, maybe even from state to state.
Well, they differ from state to state, and also they differ from like life insurance to fixed annuities. So almost all life insurance products will have what's called a contract fee. That's just a one-time charge. And that's just a way for the insurance companies to make more money. And some of them don't even pay commission on it. But most annuities, fixed annuities, will not have a contract fee. So it's important to know the rules and look at they call them highlight sheets on the annuities and do side by side. It's very important to look at multiple products in multiple states.
Yes, I think that's important. I agree. Let's go ahead and talk about transaction fees. So what are our transaction fees in regards to annuities?
Okay, so most annuities are not going to charge you on a transaction fee, but life insurance will. So it's important to understand, like life insurance, you're paying what's called a premium, and there's each premium there's a charge that they take out of there in the life insurance contract. It's always important to understand the downside of certain things. We talk about features and benefits and all the rah-rah stuff, but you have to understand the downsides. And life insurance, there are products where there's wiggle room and where they can raise fees down the road, where the fees wouldn't be fixed. Now, you don't have those problems with annuities, fixed annuities. So for the most part, you're not going to pay a contract fee, but it's important to understand situations where you might, and that would be more on the life insurance side.
Yeah. So that's a great difference between a life insurance product and then an annuity product. Most of the time, people won't be using a life insurance product as a means of a retirement fund, which is most of the time what an annuity product will be used for, is for retirement income. But so it's important to kind of like note the differences between the two, because there are products that do kind of have like an overlap or like a hybrid in ways. Like, for example, you can have life insurance that has a hybrid with long-term care. So it's important to kind of like be able to understand that there are certain fees that will go along with certain products, just depending on whatever it is and how that will impact your client.
Let's talk about that for a second. So there are also hybrid annuities with long-term care riders on there. Mm-hmm. And there are some companies that there are traps in certain annuities. And it's important to understand what they are, because and really the traps are set up for the insurance company to keep your money longer, where you can't withdraw all the money right away, because they make money on your money and the time value of your money. So it's important to understand how they make money. So what happens a lot of times is there are traps where if you pull money out, there's going to be charges. You have to know what the percentage of money you're pulling out. Also, if you have, let's say, a little bit more mature of a client, what if they have a product where you can only take 10% out? What if they get really sick health-wise? We spoke in the last podcast about the 3 different things where you can lose your money: lawsuit, stock market, or health problems. Those are 3 things that can wipe you out. So we want to protect the clients with all those 3. And there's a big variance in annuities as far as how long-term care, there may be situations where if you're in hospice care or you're diagnosed as terminally ill, you can flush all that money out because they need that money. So they'll waive a potential charge. Some annuities have it, some don't. Some annuities charge for that inside the product. So, it's important when you're doing your comparisons as a good representative that you compare what's the situation with the client, how old are they? And, the older they are, the more important that those benefits are.
Oh, absolutely. I'm glad that you touched on the almost like a withdrawal risk, in a sense of that if you need to be able to take that money out early because you have some sort of health complication that otherwise would financially cripple you, it's important to kind of take into consideration what the client's health is like. And I think that kind of goes into our next point, which is surrender charges. So explain to us what a surrender charge is.
Yeah, so there are different charges on how you pull the money out. To piggyback on the previous one, you have terminal illness and nursing home waivers where they waive the charges on the way out. So that's important to have. But also, most annuities are going to have what's called a surrender charge. They call it a contingent deferred surrender charge. And it's usually going to be a sliding scale. So the insurance company knows that they need to keep your money for a certain amount of years to turn a profit. They're not turning a profit right away. Usually it's going to be 5 years or longer. So most annuities are going to have what's called a surrender charge that are going to run anywhere from 5, I've seen 12 years. So that's a very important thing to gauge when you're analyzing annuities, what the surrender charge is and the percentage that you can pull out before the charge. So there's an annual withdrawal amount that they call it. Some companies have 10%. I know I've seen some companies that have 0 in the first year and you can pull 5% in the second year. These are what I call traps. So it's very important to understand the surrender charge rules. And that's probably the number one thing to look at when you're analyzing an annuity before you make a recommendation to your client. Because, and again, like regulations has changed now because now there are what's called suitability forms you have to fill out. And the questions you've asked me on this podcast and the last one, those are the reasons why, because you have to, the product is not suitable for everyone. Not everyone should be buying a fixed annuity. You know, they're for some people, but not for everyone. And you have to understand when it's going to be suitable and when it's not.
Yes, absolutely. I think that it is important for maybe somebody who, for example, maybe doesn't make a lot of money. They would feel more secure in a fixed annuity as opposed to a variable, because when you already have somebody that's like, hey, listen, like I'm just trying to save for retirement and I already have this 401k, but I just want to make sure that my nest egg is big enough. And they, like we had said in the last episode, where we can just kind of like set it and forget it. Whereas somebody who might be a little bit more educated on the industry and the stock market, they might be a little bit more comfortable with a variable annuity, and maybe they might have more money, they might have less, it just is going to depend on the person. But people who are more educated on the industry are going to feel more comfortable putting their money into a variable annuity because they understand what the risks are, and they'll kind of know when to really talk to their financial planner or their advisor and kind of just be able to go from there.
Yes, I agree. And definitely when you're getting to know about the person, you're doing your fact finder or however you get to learn about that client, financial savvy is very important to know what type of financial savvy they have. So, and there are ways of getting answers to that without asking intruding questions. And just in the cost of small talk, do you have the CDs at the bank? Like, what type of accounts do you have at the bank? So you get, by finding out what they already have will give you an idea, usually of their level of financial sophistication. And, and you gave one point about a variable, but there is actually a little bit of a hybrid option there. It's called a fixed indexed annuity. So for someone that, may have a little bit more financial savvy, you can buy what's called a fixed index annuity. Now it's a fixed annuity, the same characteristics of a fixed annuity, except getting the interest rate is going to change. It doesn't stay the same every year. And you're not buying the S&P, but you're buying into the movement of the S&P or one of the indexes. So it's a way of getting a little bit of a higher interest rate. And there's a cap, which let's say it's 8%. So what happens is you have an 8% cap, but the floor would be 0. So if the market does 20, you're getting 8. But if it loses 20, you're getting 0. So you're locking in last year's gains. Each year's gains get locked in. So it's all guaranteed, which is why the fixed annuities under the insurance umbrella with your insurance license, because it's insured. There's protections inside those annuities. So if someone is a little bit more financial savvy, you may want to show them, look, this is a fixed indexed annuity. Same properties as the fixed, except you're buying into the movement of an index and potentially can get you a little bit of higher interest rate. Because when you move to a variable annuity, you're giving up all your guarantees and you're also paying a lot more fees. So I'm not saying that it's a bad thing necessarily, but again, just like a fixed annuity, a variable annuity is not for everyone.
Yeah, I think that the fixed index annuity is the nice happy medium between the fixed annuity and then the variable, because like you had said before, you don't get those large market dips, but then you might not also get the superior growth that you would get with a variable. But at the same time, you're also not going to experience any of those losses either. But then with the fixed annuity, you're just not going to get as much of a return as you would normally expect.
It's no guarantee, though. If you go index, there's no guarantee that you're going higher. I don't want to get overly technical, but the index is buying puts. It's buying insurance against the S&P going down. So the way I explain it is you have upside market potential without the downside risk. But also it's important with the index annuities that you need to find out, are there limits on the cap? Because the cap, in other words, the most that you can make in a given year, that's the key. So, if the cap is 6 and we can get 5 now guaranteed, no reason to take risk for an extra 1% where you can get 0. I'll take the 5 guaranteed over 7 years all day long. So you need to look at the rules in that particular product on the cap and because those caps can change.
Okay. Yeah, perfect. And would you say that those changes will occur even from insurance carrier to insurance carrier?
Without question, from product to product within an insurance carrier.
Oh, okay. Even better.
They can have 2 different products with different caps.
So since we're actually on the topic of caps and like interest, let's go ahead and talk about some characteristics of interest rates within an annuity product. So let's talk about what the current interest rate is.
Well, it's going to change. The current interest rate is going to change from product to product, which is why it's important to have access. For me, being independent is really like, years ago when I started in the business, there were very little independent brokers. They were all captive. But, as things progress, the new business model with the internet today and all the information that's available, I mean, independence is the way to go. You're doing the right thing for your client and potentially the right thing for yourself. Because when you're captive, you have to do a certain amount of production to make your contract, to get your 401k match that you talked about, to get your subsidized health insurance, to get your rah-rah trips. So they could be putting their wallet or purse above the client's needs by aggregating all your production with one company. So you're doing the right thing for the client by being independent and having access to different companies, and you're doing the right thing for yourself, really, in the long run.
Absolutely. So let's go ahead and next talk about what the initial rate is.
Yeah, so there are some fixed annuities where they'll give you a bonus. So it's like an inducement to move it from somewhere else. So they may have let's say a base rate of 4, and you're getting a 1% bonus in year 1. So you would get 5% in year 1, and then 4% depending on how many years you chose. Let's say for 4 or 6 more years if you chose a 7-year guarantee. So you would get a 1% bonus the first year. Then you would be that you get 5 the first year, and you get 4 from years 2 to 7 or 2 to 5, or however many years you decide to lock in. So some contracts have bonuses and some don't. I like to look at the average annual return. So to compare a bonus product to a fixed product, and that average number will give you, will tell you which one is the better one to go with.
Awesome. Okay. That's some good information to have. Let's go ahead and now talk about renewal rates. So what are those?
Yes. So the renewal rate is what happens to the policy after your guarantee rate is up. So the client, with advisor's advice, decides how many years they want to lock in that fixed annuity. Now, when interest rates are very high, like they are right now, I usually would want to lock in on for a longer time frame, maybe closer toward a 7-year as opposed to a 5. But when interest rates are low, you may only want to lock in for 1 year, betting that interest rates are going to come back, because you will get a higher rate down the road. It'll change every 1 year. But again, there's maintenance involved there. It's a little bit different. Each state has a different, you have to look at what's called the guaranteed minimum interest rate. A lot of the companies, they realize, just like insurance companies do, that not everyone's going to shop. Not everyone has a savvy, independent broker, watches dip podcasts, to learn how to shop. So a lot of people a captive agent's going to be with one company. They may not have any other options. So like right now, you have the interest rates. If someone's sitting on an annuity right now that hasn't bought that annuity within 3 years, I mean, they're going to have a low interest rate. So the renewal rate I've seen drop from right now in New York State, there used to be a 3% guaranteed minimum. Then it went to 2. Now it's at 1. So they could drop your rate after that's 5 or 7 year guarantee to 1. And like, if you're not reading statements, or like your broker is not paying attention, like you could have 1 for years, and you're not doing yourself any services for your retirement getting 1% when you could get 5.5 right now with a lot of companies. So the renewal rate is very important to understand. And when you see this low renewal rate, because insurance companies, is important to understand, Kelsey, insurance companies, they're unique. They will give a higher interest rate to a new client coming in than to their existing clients. So there are a lot of companies that have a higher initial rate for new business than renewal rate for existing business. So that means you need to leave that company when your 7-year or your 5-year guarantee is up. You need to start looking at the 1035 exchange options that we were talking about before, and rolling that money into another company and another product at a higher interest rate and paying no tax.
I think that's another great thing that you brought up as well, is when you are not getting the same rates that you were before and maybe
you're not going to get those rates. I can tell you they're going down. As soon as you're falling off a cliff, as soon as that guarantee period is over, because that's how the insurance company is going to make a lot more money after that guarantee period is over.
And so I think that's another benefit too with even working with a broker, is because, I mean, for example, from a previous job, I had a 401k account, and whenever the statements would come in, I feel like I had questions, but at the same time, I didn't really have anybody to ask. I mean, I would have to call HR and then have to go through a slew of different phone numbers in order to reach the correct person, in order to ask for different like financial advice, and, say like, hey, how much more should I be contributing if I want to have this much money in X number of years and all this stuff. People don't have those resources with a 401k. So when you have
they usually don't, but they usually will have what's called rebalancing. So that's like if you have, a 40-30-30 split, stocks, bonds, and like fixed investments, where every quarter it rebalances itself. That's a potential thing where you can put that in there where it rebalances every quarter or every 6 months, et cetera.
I think that it's really important for brokers to be able to like keep in contact with their past clients, because then that's how you're going to continue to work on that client broker relationship. Because when you are keeping in check with your clients and asking like, hey, what questions do you have for me? What's been going on with you? What sort of like changes have you had in your financial state? Or like, how are do you have any questions about your current investments? Stuff like that, because then they might have questions for you, but most of the time people will be like, oh my gosh, I need to call Rob, but oh my goodness, he might be busy and I just like don't know what to do. So like, either that or like I keep meaning to call you and I just kept forgetting. So it's really important for you as a broker to reach out to your past clients just to be like, hey, like what's been going on with you? Because, and then in turn, that means that your clients are going to continue to refer people to you because they're going to be like, wow, you actually care about me.
It's so true. And what I call it the check-in call. We try to do that at least once a year, or just call and touch base, check in. Is there anything I could do for you? It's good to ask an open-ended question, and they'll either say yes or no, or they mean to talk to you, or about, what, I got my friend. And definitely you'll get more referrals with the check-in call, because you don't want to be the person where every time you call, you're looking to sell something.
Yeah.
So you do one check-in call a year that you're not selling something. Now you're a person as opposed to a salesperson. It makes a big difference.
100%. I am telling this to my brokers all the time because I get tons of questions on.
Just check in.
Yeah,
When
exactly.
things are slow, they used to call it the Sunday night blues in the insurance industry. Like when, you're looking, okay, Sunday night and I only have 3 appointments to speak to people. And I'm getting a little depressed about it, and Monday I have no appointments. Make your check-in calls that Monday when you think you have nothing to do. Make a few calls and you will generate business.
Yeah, exactly. And I like I said, I tell our brokers all the time, I'm like, this is what you need to be doing in order to generate leads, especially on social media. Don't go about it in means of selling someone something. You should be networking and using social media as a tool and get in touch with people in like Facebook groups or LinkedIn groups and genuinely connect
Groups
with
are great.
people. Exactly. And so then when you're connecting with people, you're not selling anything. And when people do have a genuine need, you are there. And then you become the first person that they think of because you're fresh and at the top of their mind.
Yeah, I want to touch on this. So there's a saying, content is king. So
Hmm.
very important to educate. So we do a monthly newsletter, an e-newsletter. And I use a company for this called insurancenewsletters.com. They're pretty good. So what happens is they get an email newsletter, and it goes to 1,000 people once a month. There's 3 articles, and they write them for me. But in the beginning, I was using all their stuff and their titles, and I was under a 20% open rate, which is really, they say the goal is 20 to 25. And I was doing under 20. I was like, I'm trying to analyze this. Why is this like this? I write a weekly newspaper column called The Financial Wave. And so I said, you know what? First of all, I think my writing is probably better than theirs, but I don't have time to do all, what they're doing for me. So I started inserting 1 or 2 of my articles out of their 3, because theirs are all insurance based. And I write stuff, common interest. I write about pizza, the cost of pizza, which is called the Pizza Project. New York City pizza, a slice used to be similar to the cost of a subway token. So I've written human interest, travel tips, things like that. So I now will insert 1 or 2 non-insurance based articles, and I change the titles. I'm writing my own titles. I'm writing I think this month is going to be sugar kills and why. All right. So there's a lot of reasons why we're obese and sugar's killing us slowly. And all we want to do is just pop pills instead of stopping to eat the sugar. And you wonder why people are running out of money, because they're sick. So you want to save more money for retirement, eat better.
And also and if the sugar is deteriorating our teeth, which means that we have to spend more at the dentist too.
More to dentist, and that's where the majority of the germs in your body are in your mouth. And I actually
Yep.
wrote a column about that. You're right on the money. So these are things, fun stuff and human interest. So I've changed the title to be non-financial insurance based, and I insert 1 of my human interest stories, 1 or 2 out of the 3, and my open rate has been close to 40%. I doubled the open rate.
See, exactly.
That's a big number.
Yeah.
So again, an e-newsletter, or I have a CPA that actually sends still like an old school hard copy newsletter. It's like 3 pages of like all these people like tried to cheat Uncle Sam, and it's like he's telling you all the stories, what not to do and why to call him. But like, it's just good to you're educating without selling. I'm educating. I ran into a friend the other day. I wrote a column about electric vehicles, not so fast. and explaining why you're not really saving the big money right away for a lot of reasons. And my mother's in the hospital, and I was speaking to one of her nurses who just bought a Tesla in January because the prices were lower. But the new Teslas, they don't give you you don't get the charger with it. And then she had to like convert her garage because it didn't have the proper 110 to do the charging and all this extra money she had to pay. And then she can't find a station. And then at her job, there's only 5 charging stations in this huge parking lot, and she's got to wait. And then she realized, I'm not saving that much money. So, that's interesting things. And so I ran into a client and she says, I read your electric vehicle article. It's really good. I was like, oh, thank you. So now I know she's reading it. And the newsletters, you can see who reads it and who doesn't. And if someone's reading a newsletter, every time you give them a call, say, hey, how you doing? Just checking in. I see you're reading my newsletter. And that's a nice opening to do some business.
Exactly. It's a means of creating connection, which is really what is going to help people stick around with you, and why you're going to be able to retain those clients is because, but like you had said in our previous episode, was that people don't want to do business with you just because of what you do. They want to do business with you because they like you.
Yes, it's who you are more than what you know, but also, and you guys are called DIP, this is called drip. So when you do a monthly newsletter, we call it dripping, like, existing clients get it, new clients get it, but also people that I'm targeted, I want to do business, or centers of influence, or people that have, they have like CPAs that have their own client base. I mean, I'm educating them as well, and we call it dripping on them. So it's important just to, be out there and be in contact with people, whether you're selling or not.
Oh, absolutely. I'm glad that you had talked about doing like drip campaigns and continuing to educate even people in adjacent industries, because that in and of itself is important, just like minimum guaranteed rates. So let's go ahead and talk about what a minimum guaranteed rate is. And you had kind of touched on that a little bit earlier.
Yeah, absolutely. So the minimum guarantee rate is no matter what happens with interest rates, your contract will get this rate. They used to be higher, and now after, since we had record low interest rates over the last 5-10 years, most states have lowered their minimum interest rate. So it's important to look at what your state, the minimum interest rate in your state. And if you have a situation where you may have, you have people, you look at 2 states, as we talked about before, you're looking at the fees and the premium tax, but minimum interest rate is something else to take a look at, because most people would not have the fortitude or the foresight to do a 1035 exchange at the exact time where their guarantee period is up. Usually, like, there's a few months, or they realize it, or sometimes it can go a couple of years, like, wow, I thought I was still getting this interest rate. I should start reading those statements that come in here. So the minimum guaranteed interest rate is very important. It's worst case scenario.
And tell us a little bit more about the possibility of having multiple interest rates within one annuity account.
Well, I mean, yeah, there could be a new rate and a renewal rate. And most of the insurance companies will give a higher rate to new business than they will their existing clients. So it's important to know the differences. Once the new rate is over, the renewal rate is going to be lower. It's almost a guarantee. And that's when you have to start moving it and, reach out to your broker and what else is out there.
Yes. So next, let's go ahead and talk about surrender rights. So what are surrender rights in regards to annuities?
Well, surrender rights, there's 2 ways of looking at it. One is, how can you surrender? How can you pull the money out of the contract? Depending on how long you've had that contract, you're at the inception of a contract, you have to take a look at how long the surrender charge goes. Most annuities will usually about 7 years. Now, some could go higher. And there are companies where if you take a 10-year surrender charge product instead of a 5, they'll give you a higher interest rate because they know they can keep your money for 5 more years. So it's important to understand the surrender rates and how long you want to lock in. And sometimes that's age-based. Like if you're in a situation where you're 52 and at 59 and a half, okay, so one of the charges in an annuity, when you pull money out before 59 and a half, there's a 10% penalty. It's called a premature distribution charge. So that, because Uncle Sam they don't want you to be able to defer the rest of your life. That's why with an IRA, used to be 70, but at 72, that now they force you to start taking the money out because that's pre-tax money. Uncle Sam hasn't gotten his share, so to speak. So, age has a big difference into, how long you may want to have a surrender charge on your product and how you take money. There is one thing, and it's a little advanced, maybe that would be in the next podcast we could talk about, but there is one way of avoiding that 10% penalty before 59 and a half, where it's called Rule 72T, where you can take equal systematic payments before 59 and a half and avoid the 10%. So let's say you're 55, you would take the same payments at 55 to 60, and you wouldn't pay the 10% by taking periodic systematic payments.
That's a really cool feature, including like a benefit as well. So actually, that was going to be my next point here too about annuities, were the benefits. So let's go ahead and go through the life-only benefit of an annuity account.
Yeah, I would call it really more like a settlement option. Like, see, what people have to understand, like we're talking about what they are, but to me, it's more important what they do. So like when someone wins the lottery, for example, each state has their own lottery. It's great for taxes for the state to as a money grab for taxes. So they give you two options usually. They give you the option lump sum or systematic payments. Well, the systematic payments, that's an annuity. Okay, so which, I mean, if you're a younger person, you shouldn't be taking lump sum because you're paying all that tax up front, and the state loves it. That's why they encourage you to just take the lump sum. Don't you want access to all your money? Who needs access to $50 million? You're never going to spend it in 1 year. So that's an annuity. There's someone takes a pension option, like they have the pension. They said, okay, now you have to make your decision. Do you want to take 100% and leave your husband or wife zero? Do you want to take 50%? Those are annuity or settlement options. So when you say benefits, it would be more like a settlement option. But so life only, one of the best things about annuities and about life insurance, because a life insurance, you can roll into an annuity and get these same benefits. You do what's called a 1035 exchange that we talked about. So life only means that you're getting 100% of, depending on how, there's a calculation of how old you are, how much money's in the annuity, and you're getting, let's just call it $10,000 a month for the rest of your life. Now, years ago, there was no checks, what we call checks and balances on those. If it's a husband or a wife and they choose the maximum option, the spouse was not aware if that spouse who has the pension coming in dies and zero goes to the spouse. It's not fun to find that out after the person dies. Like, what do you mean? I thought I get this. What happened to his or her pension? I thought I get the pension. Well, if you took the life only option, that's not insured because insurance is gambling. There's a probability of something happening. So depending on how old you are, you take a life option. Yeah, you're getting the highest payout, but your heirs get nothing if you die. So the insurance company makes money. So it's a gamble as to how long you're going to live. So you got to think about like, how long have your parents lived? What kind of health are you in right now? Like all these things have to come into play when you're deciding your option. So life option is you get a maximum payout, but nothing goes to your heirs or spouse. There's a sign off now. So the new rule is there's a spousal sign off on these options where the spouse has to sign and say that person is aware that they get nothing if you die.
Oh yeah, that's something good to include and point out as well, is that they have to be aware, and there will be paperwork that they have to sign as well. And that kind of like leads us into our next couple of points as well. So here I have next with life with period certain. So explain to us what that is.
Yeah, so that's why annuities are under the insurance umbrella, because now you have insurance on your plan. So what that means is, let's just say you put my client, let's just say you put the $1 million in, you're getting $6,000 a month for life. Let's say that she dies in, let's say 2 years. In 2 years, she's only gotten back 144,000, 72,000 a year, 6,000 a month. So the insurance company, if she had life only, insurance company would be keeping, I mean, do the math, what, over $800,000. So with the period certain, you're guaranteed that the heirs would get that money for a certain amount of time. So if, back to the original example, she puts $1 million in, she dies in 3 years, the beneficiary would receive the next 7 years of payment if it was, let's say, a 10-year certain. So it's guaranteeing that income will be paid to someone for a certain amount of time frame, a certain period. That's where the period certain comes in. Life with period certain. So that's why it's important for brokers to compare policies with different companies, because you can see what the difference is. And I just had a case just right now. She wanted 100% joint survivor, her and the husband. Now she's 71, he's 75. And so I was going over the different options. And originally she wanted life only. And I explained what I just explained to you. She's like, I don't want that. Okay. The insurance company wants you to do it because, if you don't live that long, they're keeping a big chunk of your money, and your heirs or your spouse are not going to get that money. So you're insuring the payments basically by utilizing some of these other benefit options.
Absolutely. And actually, I'm glad that you brought up joint and survivor, because that was going to be my next question for you. So go ahead and elaborate on the benefit of the joint and survivor.
Yeah. So joint and survivor would be like what I explained before. Like you could do 100%. So if she's getting the 6,000 a month, she passes away, her husband can get the 6, or she could do a 50% option, because now see in this particular case, and I brought it up to her husband's got 2 different pensions. She has none. So this is going to be her pension. So he doesn't need as much money if she passes away. So she could have chose joint life with 50% to the survivor, where he would get 3,000 instead of the 6. So that's an option. And you get a little bit of a higher payout with the 50% than the 100, because the insurance company doesn't have to pay out as much. Absolutely. So joint and survivors, those are important decisions to make.
Yes. And that's also another consideration that I feel like brokers need to take when they go into an appointment is, what is your spousal situation like? Are you married? Are you divorced? Are you separated? Things like that, because they do come into play. And especially when, sometimes people have messy, marital relationships. They're not always, sunshine and rainbows. So, it's kind of important for when you are investing into an annuity product, you want to make sure that are the right people going to be getting the money, and, do you actually want them to?
No, you're making a really good point. I do a lot of business with divorce attorneys, matrimonial attorneys, because a good time for brokers to be speaking to clients is during, you mentioned a little bit before, life-changing situations, getting married, getting divorced, having a kid, retiring, changing jobs, getting laid off. These are times to reevaluate the situation. And When you have an annuity, the beauty is also you can change the beneficiaries at any time. But there are situations where someone may be on a second and third marriage, and things could get a little ugly. So these are important things to talk about, and they need to know what their options are. The divorce rate is 50%. That's on first marriages. It's 60% on second marriages. So, and again, it's not to be necessarily negative on marriage, but we try to be realistic. If someone just gets married, there's a 50-50 shot they're getting thrown back in the sea, and that their finances are going to change.
Yeah. And I think that has a lot to do with that's a whole nother ball of wax. We'll get into that into another episode of why I think the divorce rates
I'm
are
happy
higher.
to come back and talk about that.
Yeah. Let's go ahead and talk about the death benefits.
Yes. So the death benefit in most annuities is going to be lump sum. At that point in time, there is a tax to be paid, and it's going to be a tax on the gain. So, for example, you put in $30,000 into an annuity, and it sits there for 30 years, and now it's $100,000. You pass away, your beneficiaries, the $100,000 goes to the beneficiaries, but 70% is going to be taxed as taxable income because that's the gain.
Mm-hmm.
So there are also ways to reduce those numbers where if you decide you have a lump sum and you can actually pull money out, because when you pull money out of an annuity, existing annuity, its interest comes out first. So in the same scenario, if you put in 30 and it grew to 100, the first 70 that you take out, if you're withdrawing, aside from you're not passing away, you're withdrawing the money, that's going to be taxable. So it's important to understand the basis of that policy, and the insurance company, like what you originally put in versus what's in there. And because you have to manage how you're going to pay those taxes when you pull the money out. But when you die, your beneficiaries are going to get that money lump sum, and there will be taxation, unlike life insurance, which is tax-free.
I like that you brought up about what it is that you're putting in. So like essentially like your monthly premium. So let's go ahead and explain what the waiver of premium is.
Yeah. So waiver of premium, that's more for life insurance. So what happens is with life insurance products, again, there's a three-way scenario. You either live, die, and become disabled. A good benefit for life insurance is waiver premium. So if you become disabled, obviously, especially for younger people, disability income insurance is really critical. Like we do business with like a lot of physicians because it's really important, because they go from making I have a doctor that's going from 80,000 and then will be making in 18 months is going to be making about 430. So it's easier to plan with them because you know how much they're going to make, so disability is important. But so what the insurance companies do, if you become disabled, they waive your premium, meaning that the insurance company will pay for your premium on a life insurance policy. However, there's two different types of waiver premium. One is the full waiver premium, where if you're paying $600 a month, they'll waive the full $600. But then there's another type where it's called waiver of monthly deduction, where they're only going to waive the cost of the insurance. So you're paying $600 a month, but a lot of that money could be invested. They may only waive $150. So you don't have to necessarily put the rest of that money in, but the policy is not going to grow because they're only paying the cost of the insurance. But you're not going to really get waiver premium on fixed annuities because your health is not relevant.
Mm-hmm. I think that's something that's really important to note too, just because none of us have a crystal ball. Like we never know what's going to happen. Like, God forbid you can get into a car accident on your way home from work today, knock on wood.
Yes, we call it the Budweiser truck. We say, well, like I'm in a meeting because, people have different issues with death. I say, let's just say, for example, you guys are, you're going out in the car and then the Budweiser truck wipes you out. Okay, you need a secondary beneficiary. What happens then?
Yep. So let's go ahead and talk about the 12 advantages of fixed annuities, and let's pray that one of them is not a Budweiser truck.
Okay, so the first is guaranteed interest rates. So beauty of the fixed annuity is exactly how much money you're going to have at the end of the term. You can do the calculation. You can do what's called an illustration from the company, and you can say, look, this is 2023. You go with a 7-year guarantee. 2030, I can tell you exactly how much money you're going to have, assuming you don't withdraw any funds from it. So it's guaranteed certainty is a beautiful thing. And you have certainty on your interest rate and your principal. So those are two huge advantages. 3 is going to be interest rates. Insurance companies will usually, and again, if you do the proper research, as an independent broker will do, you look for the highest interest rate, and you're going to get a higher interest rate from the insurance company than you're going to get from a bank. And also a fixed annuity is going to grow much more quickly than a CD, because at the end of the year, even if you don't pull the money out of the CD, you get a 1099, you pay tax on the interest. Also, a CD is not liquid. So if you break a CD, you take the money out, you lose all the interest in the whole period that you were in the CD. So if it's a 2-year CD, you've lost all your interest, but the annuity gives you, withdrawal options with no fees. So interest rate's very important. Tax deferred. So you're not paying tax like you will on a CD, just like I was mentioning before. That tax, you're getting compounded interest and tax deferral, which means that the money's going to grow a lot faster than taxable investments. Protected from creditors. So you have a situation. So any products that can protect you is a good product. And the annuity, fixed annuity, it's protected from stock market loss because there's no market risk. You're only looking at interest rates. And if you get sued, you're protected from creditors. They can't get at that money. money. So that's why a lot of attorneys we work with, they refer clients. They say, look, put them in one of those fixed annuities. They got all this money. I don't want them to blow it. And I want them to have access to some of it, but not all of it. And if they get sued, I don't want them, losing all that money. So it's a great place to put the lawsuit. Bypasses probate. We talked a little bit about that. So the beauty of an annuity, there's what's called a designated beneficiary, which means when someone passes away, it doesn't get stuck in probate, which can take 6 months to a year where they don't get the money. Usually we can have them get that money in a 7 to 14 day time frame, depending on how fast the company works. But from the point where you get a death certificate, usually we can get that money fairly quickly. Probate means proving the will. So whatever one of your assets that does not have a designated beneficiary has to go through your will and go through probate. Your nosy neighbor next door can go down to City Hall and see what you had in probate when someone passes away. That's inside information, and other people to know your business. And also you're paying court costs on it, and you can get contested. So beneficiaries can contest your will, which now you have to hire a lawyer to prove that the will was valid. So, it can get very messy. Lifetime income options available. We touched a little bit on that previously, just before, where it's the only product where you can set yourself up for guaranteed income for life. And as people age and get a little older, the biggest fear is running out of money, and you can guarantee that's not going to happen because you just set yourself up with your own pension. You have annual withdrawal options that are available. So unlike a CD where you can't pull money out without penalty, most annuity contracts will allow you to get 10%, either 10% of the principal or 10% of the total amount. There are products that will allow you 20%. There's what's called roll up, where if you don't take the 10% in the first year, you can take 20% in the second year, which is kind of nice. So there are definitely some different types of withdrawals that from annuity to annuity, which is another reason why it's important to do your side-by-side comparisons. And then annuitization, which is, converting your lump sum into an income stream. Just to give you a quick example, like the power of annuities. I got a call from a client of mine. He's a personal injury attorney. He hit a huge case. He's in the middle of a divorce. Wife knows this money's coming. And he's like, well, what can I do? I said, well, you could buy an immediate annuity. And the immediate annuity allows you to wait 12 months before you take your first income. When is this case going to get settled? Over the next 90 days for sure. I said, well, so he took his fee. He never took what's called constructive receipt. Like he didn't cash the check. So he had the insurance company cut a check to another insurance company, and he did a structured settlement of his fee, put it into an immediate annuity, got divorced, and it was a 7-figure commission he was getting on it, and that money disappeared. So that it was not included in the divorce settlement, and he was able to save all that money. Yeah, so annuitization, very important. State protection. So FDIC, we just had the banking crisis. So it hit me hard because I came back from Antarctica on March 13th, which is a Friday, and that was a day where everyone started pulling their money out. I'm getting these texts on WhatsApp, like, let's talk about the banking when you get back. I'm like, what banking? So I didn't know what was going on. It takes 4 days to get back from it. So I come into the banking crisis, and I'm also a guardian. I have 2 wards where I take care of all their finances and their medical stuff, and I pay their bills. And we had accounts with First Republic and Signature Bank. So obviously that had to be moved. But with the banking industry, state protection is very important. So annuities, and I compare them to chocolate. So I'm a chocoholic. I love pizza and other things. Although Hershey is not quality chocolate, those little Hershey Kisses that you buy. So yeah. Hershey Kisses, so that they come in, there's a wrapper. So, you have the chocolate. And I once took a course. It was a chocolate tasting course. Very interesting. I never had Hershey's again, by the way, after that course. So they put an aluminum foil wrapper around the Kiss, and then they put it inside of a box. So you have double levels of protection. Well, you have the same thing. Annuities can be like chocolate. So what happens is if the insurance company goes down, there's what's called a guarantee association. Each state has one, and the insurance companies are members. So if one insurance company goes down, the other companies kick in to pay off that claim. And if they all go down, the state has a backup, and each state has a different cap on how much they'll protect. Most states go for between 100 to 250,000, and that's life insurance, cash value, and annuities. But each state is different. So it's important to understand, like people ask me, what are my guarantees? What happens if the company goes under? These are good, legitimate questions. I explain you have 2 layers of protection, like a Hershey's Kiss. Okay, you have the guarantee association, which is your aluminum foil wrapper. Then you have the state that's going to come in, and that's your box that goes on, that goes on the ship. You have double protection, state protection, very important. And last is peace of mind. We talked about set it and forget it. I like that you used my phrase. You have peace of mind knowing that you don't have to be paranoid about what's going on in the market. You're not watching, you're not getting agita because you're getting an X amount on your money, and how much money is going to be there at the end. You have certainty, and certainty is a beautiful thing, and it decreases stress.
I like your chocolate scenario. So my next question for you is, I know that we kind of already covered this in our previous episode that we did, which was episode 17. So can you replace an annuity? And if so, what would occur, and what is that process like?
Yes, so you can replace an annuity, but You shouldn't be doing it in every situation. The best time to replace annuity is when it's past the surrender charge period and the interest rate has gone down. That would be a good time to roll it over into a higher paying annuity with a different company. Most companies will not allow you to stay with the same company and roll into a different product. And there is paperwork and it does take time. Usually you get to lock into the interest rate for 60 days. I've got an interesting situation right now with, I think I mentioned the last podcast with a woman who has money inside of a hedge fund pension. She wants to pull the $1 million out and they will only cut one check a month and they need 60-day notice. I said, this creates a problem for us because if we write it now, first of all, we passed the deadline for July 1st. So the earliest that she can get a check now is October 1st. I said, we can't do the paperwork right now because if we do it now, I can only guarantee the interest rates for 60 days. So you don't know what the rate's going to be. So we have to now basically revisit this whole thing in the first week of August to lock in whatever the interest rates are at that time. So when you do a rollover, you get a lock in at what the current rate is, or if the rate increases, you get the higher rate. So it's important to know these rules and to time it properly for your client to put them in a better position. So it is a little involved doing a 1035 exchange. It's more paperwork, but you're doing the right thing for your client. And it is another sale. And the downside would be, though, that the new contract now will have a new surrender charge. So they will not have access to all the money. And you have to take that in consideration and explain that to them.
Mm-hmm. Is this actually what the free look period is?
No, the free look period is what I would call buyer's remorse.
Oh.
So someone buys a policy and maybe the broker didn't do a good job of fact finding, pressured them and did what we talked about in podcast 17, just, talking features and benefits, not really taking into consideration their situation, and maybe it was pushy. When you get a call the next day after a meeting, that could be what's called buyer's remorse. So most annuities will allow a 20 days, some have a 30 days to reverse the transaction and get out of it.
I am definitely one of those people that experiences buyer's remorse on pretty much every single purchase that I make, whether I needed to make it or not.
One way to avoid buyer's remorse is to offer the client 2 or 3 annuity options and let them choose, because they're the ones who decided now. You didn't tell them what to do.
Exactly. And I think that also goes a lot into educating your clients as well, because the more educated that they feel, this is for any line of business, whether it be annuities, life insurance, Medicare, when you're able to present all these different products and the features and benefits, and even some of the caveats to all these different products and the product lines, is that when people feel like they are more educated and they feel like they are autonomously able to make the decision for themselves, they have less buyer's remorse. They're less likely to, cancel the policy because they made the decisions themselves and it wasn't you who made it for them and they didn't feel forced into the purchase.
Absolutely. And one thing that interesting thing you could do, I like to, there are times when I'm talking to them, I say, am I making sense? I say, yes. Okay. Well, if someone else had to ask you why you purchased this, what would you tell them? And then you'll see how what they've retained and what's most important to them by doing that. So just like, let's just say, for example, because I like to, plant seeds. Sometimes they call me Farmer Rob. I like to plant seeds. That's, because they're talking about their family and other siblings. And I'll say, well, okay, let's just say, for example, you refer me to your brother and your brother's like, okay, you got this fixed annuity. Why'd you buy it? What would you tell your brother? Now they're telling you the benefits. They're selling themselves. And also you're setting yourself up for a possible referral to the brother.
That is a really, really great
marketing
strategy too.
It's a technique, but you're also doing them a service because they may mention a couple of things that aren't true. And that's an opportunity to correct them where that, it may or may not be true. They may not fully understand it. So then you review it again and you're not going to get that buyer's remorse.
That's a really, really great strategy. I like that.
That's called buyer's euphoria.
Yes.
They're all fired up. And here's the reason why.
So since we're talking about being fired up, what are some of the biggest benefits of annuities?
Certainty, being able to set it and forget it, not having to get all stressed out when your quarterly statement comes in, because annuities are going to have an annual statement, fixed annuities, not quarterly, because they don't have to have quarterly statements because there's no chance of losing money. Also, you can concentrate on, your business or quality of life and not have to be watching the market or the ticker. People get stuck watching these tickers all day long. It's not good for your mentals. So, there's peace of mind is a big factor here with fixed annuities and certainty. And, if you're in a situation where you're moving up in age and you've taken a lot of your risk off the table, it's a lot easier to go on these vacations and enjoy your quality of life when you're not asking oh, wow, what happened to the market today? You don't have to worry about that kind of stuff if you're in a fixed annuity.
Absolutely. So let's go ahead and outline what are some of the caveats or pitfalls to annuities.
Yeah, so definitely there are what I call traps to annuities, and that they're not for everyone, and you have to understand what some of these traps are. One is liquidity. There are some annuities where you can't pull money out the first 2 years. Now they give you a higher interest rate. Also, there are companies that may not be A rated, like be B rated, they'll give you a higher interest rate, but there are traps. You got to look for the traps in those products. And when I call traps, things where you can't pull your money out. Most annuities will give you 10% per year of what's in there. Some will give you 20, some will give you 5. So that's a trap. There's what's called a market value adjustment. And what that means is it's interest rate protection for the company. So it's another trap. So if you're pulling monies out, when interest rates are going higher, they can penalize you and you get less money if you liquidize your contract. If you pull money out when interest rates are going lower, then you may actually benefit from it. But again, it's a protection for the company. There's no reason why you need to buy a contract that has a market value adjustment. And fees, for the most part, in a fixed annuity, you're not going to be paying fees, but you have to look. There are a few that will charge a fee. So you have to look at the traps, the fees. You want to look at the minimum interest rate that we talked about, what kind of liquidity they're giving you. You want to have options where if you get terminally ill or you're in a nursing home where they have a nursing home waiver that they get charged for it. Some annuities will charge for that. So if like you're writing an annuity for someone who's in their 60s or 70s, like that's important. If you're in your 20s, not as big of a deal, but who's to say you don't get into an accident and need it anyway? I mean, you don't know. You're trying to look at hidden traps, and those are things that I want to look for when I'm looking at it. I'm breaking an annuity down, so to speak.
That's really important information to have, is especially when we're talking about the pitfalls and the traps and the different fees and stuff, because sometimes those things can be hidden. And I think that's the reason why it's really important to have a really broad product portfolio.
Not only that, but there are a lot of the companies, what they do, I call it HIP National Bank. So what they do, they'll pay a higher commission to a broker for their product than another company will. They're going to have a trap. There are companies that, well, if you do a certain amount of production, like you can pick something off their website, which they're not supposed to be able to do. There are companies that you have to look at the highest, because you have spreadsheets that these are the highest interest rates, but interest rate is only one factor of the annuity. You want to look at the other traps and what kind of liquidity do I have, and are they charging me if I want to pull the money out if I get sick? So there's a lot of factors that need to come into play.
Absolutely. And I think that when you are a broker that is really educated on the industry and like the different products and even insurance carriers, and you're able to kind of compare them side by side for your clients and be able to make great recommendations for them, that is really what is going to help grow your business. Because again, like we had said before, your clients then feel educated, they don't feel sold.
Also, when you're independent and you're doing, like I explained the whole process to this woman with the $1 million. I said, look, first we have a spreadsheet with any B-rated companies removed. So now you have A- or better on ratings. All right. Then we're taking the lowest interest rates and they're removed. And so we came up with 3 different companies after that search. Now, like years ago, you would have to call 3 different brokers to get rates from their company. Now with the internet, you don't need that. So when you're saying, look, we looked at 100 companies, we went through this whole process, they're going to be less likely to call somebody else because you've done the due diligence for them.
Exactly. Yeah. And especially when we shop online, most of the time we're like, sitting there hitting all the filters, and we filter by size, we filter by color, we filter by like whatever it is that, in regards to whatever we're shopping for. So shopping for an insurance product like an annuity should be no different. And that's a huge benefit to working with a broker.
Yes. And I've done it. Articles on internet shopping. I'm glad you brought that up. So shopping online is a big deal, and you have a lot more information, but there's online coupons. There's other things you can do to defray your costs. Online coupon would be like an annuity that doesn't have those traps. So shopping for annuities is not that different from shopping from other things.
Exactly. Well, Rob, thank you so much for all of the conversation that we've had today. So what advice do you have for agents who are either new to the field or even seasoned agents that are looking to add annuities to their product portfolio?
Yeah, I would say, like, first of all, I know you probably have like a lot of Medicare reps. Medicare is a really big deal right now, and 10,000 people turn 65 every day based on the aging of America. So I just did a class for Medicare reps, and annuities are probably the best things. If there's something else that they want to add to their portfolio when they're doing Medicare supplements, fixed annuities are really the way to go. I mean, it's the same type of market. You have more mature, older people with more money. And when you're doing the application, there are a lot of different things in that application. We've taken the information down that could lead to planting the seed for annuity sales. Also, it's good for, financial advisors, people that are in the stock market. Fixed annuities will be a good secondary option for the safe money for their clients. Because what happens with annuities, and I have the saying that the riskier the investment, the more the broker makes. So there's no risk in an annuity, so there's different compensation level. So there are brokers that just want to do risky investments for their clients, but they should also have a stable of fixed annuities for the safe money for that client. Very important also for new reps. get a good mentor, continuing education, take courses, do self-improvement, try to find a really good producer and take them out to lunch, ask them some questions like, what's your secret? What works for you? Sales course, it's really good stuff. So self-improvement, very important. And try to find a situation where you're in an environment that is with successful people, because success breeds success. I started with Prudential right out of college, and then they have they unionize, they like pressure me to join this union. Like, what do I need to join a union for? I'm an insurance guy. What does that have to do with anything? And I found out that and I'm not negative on unions necessarily, but in that particular case, the union, they were protecting the lower producers. The people, it's just there's no reason for that.
Yeah.
So again, stay positive, put yourself in a positive environment, try to figure out if systems work. Systems are good. So if there's a company or an office that has certain systems for generating leads, that's good. Follow your passions. People do business like, cocktail parties. Like, I'm the anti-agent because I'm not pushy. Okay. I'm not pulling tricks, doing salesy maneuvers. I'm not giving you jargon, insurance jargon. I want to be at a cocktail party when people want to come to me and hang out, talk about pizza, other things. Okay. As opposed to the pushy insurance guy where you're running the other way. Oh, that's my insurance guy. So, be affable, be friendly. Don't be pushy. Don't be salesy. Educate. Don't sell. You can educate. You don't have to sell. They'll buy it.
Snaps for Robert, because that is honestly some of the best advice too. I think
follow your passions too. I mean, look, that Ted Lasso show. That's like the guy didn't know anything about soccer, then all of a sudden he's passionate about it. I mean, if you're a soccer mom or soccer dad, that's a good place to get to know people. And look, they have kids. They need insurance. They need annuities. It's a good place to, subtly prospect.
Absolutely. I've been making quite a few TikToks about that and how to generate leads for the summer 2023, especially since summer is going to go by so quick. And then here we are going to be in AEP, before we know it. So that's another great way to generate leads, is to make sure you're going out and networking with people, go to the sporting events and go talk to the parents, because who is our customer? Where are they? And how do we speak to them? And I think that's all really great advice.
No question. I try to do 2 or 3 events a week, and also networking groups could be good. So if you want to join a networking organization where they have events and things to go to where you meet new people, that's good stuff. And you could do it on Zoom as well.
Absolutely. Well, awesome. Rob, that is all really, really amazing advice. Thank you so much for being my guest today. Thank you so much for joining me on today's episode of the Direct Insurance Podcast. It was wonderful having you. And I hope that everyone out there listening learned something new today, because I know I sure did. To view this podcast after it airs, you can watch it over on the Insurance Advisors Direct YouTube channel. And speaking of YouTube, make sure to follow us on social media. We are on Facebook, LinkedIn, YouTube, and TikTok. So Rob, where can people find you if they want to get in touch with you?
Yes, I welcome all phone calls, even if it's not insurance related, because I'm a connector. People know that whether I get calls for Medicare stuff, Medicaid, travel, whatever it might be, and I'm going to connect them to someone. So be a connector. I'm a connector. Have a team behind you. You can call me directly at 917-359-3985. You can send me an email at rob@insurancedoctor.us. U as in United and S as in States, spelled out, insurancedoctor.us. Or you can go to my website. There's a lot of there's some videos, there's a lot of educational things on annuities as well, and articles I write for the local paper at www.insurancedoctor.us. But do something, reach out. Looking forward to speaking with you guys.
Awesome. Well, thank you so much, Rob. And again, if you are an independent agent or thinking of becoming an independent agent and you're looking for an industry partner, we here at IAD would love to be considered. So if you want to learn more about IAD, you can visit our website, www.iadbrokerage.com, or you can call us toll free, 1-800-381-0977. Thank you so much again, Rob. I really enjoyed our conversation today, and I hope that everybody out there found it really helpful. And I look forward to hearing from you again soon.
My pleasure. And I'd love to come back. Had a great time. And thanks for having me.
Awesome. Thank you so much. Bye.